There is a massive misconception out there. Most people look at their investments just in US dollars. How much did my gold go up? How much did I buy it for? How much is it worth now? How much is my crypto portfolio now worth? How much is my stock portfolio worth? Or how much is my house worth? Now, the issue is that the US dollar is going down over time. And because of that, over time, all asset prices are going up. Now, because of that effect, it makes it very hard to distinguish what asset class is currently cheap. Should we rather buy houses? Should we rather buy stocks? Should we rather buy crypto? And what kind of assets are comparatively expensive? In this video, I want to share something that took me years to figure out. Because here's the conventional wisdom. This is the S&P 500, very long term, starting in the 19th century, and it's denominated in US dollars. And the reason to buy stocks in this example is because the S&P 500 over time goes up. And the reason why some people do not buy stocks is because sometimes, this is now on a logarithmic scale, we do see crashes, right? We had our crash in the 1930s of more than 80%. We had the oil crisis in the 70s where the S&P 500 went down almost 50%. We also had just our recent quite significant corrections, right? The dot-com bubble burst, also almost 50%. And then over here, the global financial crisis, another 50% correction. So this is why a lot of beginners, quote unquote, don't invest. They are worried of losing their money. And the chart is pretty obvious, right? The chart shows us over time, the S&P 500 is going up, and so are all other asset classes. So if we just have a long enough time horizon, we can just buy into whatever asset is our favorite and then just wait it out. But here again lies the problem. A dollar today is not worth as much as a dollar, say, 30 years ago. And so even though we might get the same US dollars or even more US dollars in a few years from now if we buy the wrong asset at the wrong time, even though we might have a higher number in our bank account, that higher number might not be able to buy us more product. That's the problem. Now, here's the nice thing about those kinds of problems. The numbers are official. We can have a look at how many dollars are circulating, how much is the monetary base expanding over time. We can quantify all of those effects, and we can then say, does it really make sense to long-term, for example, buy stocks? Are currently stocks cheap or expensive? What about precious metals, etc.? We're going to look at all of this in this video. So again, this is the S&P 500 long-term on a logarithmic scale and here on a linear scale. The difference between those two scales, by the way, is that the linear scale just looks at US dollars and the logarithmic scale looks at percentage changes. So when we see a drop like this over here, right, more than 80%, then a similar drop in the higher level on this chart would be the same distance vertically. Or to make it a bit easier, this over here is a 3x and this over here is a 3x as well. We don't have that on linear scales, right? On linear scales, we can't really see what happened in the early days. So that's why logarithmic scales are useful. But again, this is the S&P 500 long term. This is the NASDAQ 100 long term, right? So those are now technology stocks. By the way, this vertical line here, in case I didn't mention yet, this is the launch of Bitcoin. So Bitcoin was launched during the global financial crisis. It has not yet seen any major corrections during its existence. The COVID crash over here is quite small, comparatively speaking. And then over here, we've got gold, right? Of course, also gold goes up over time. And again, the reason for all of those charts going up over time is not because gold is now way better than 50 years ago, or the houses that we bought 50 years ago are way better today. They're the same houses, they're potentially even worse, right? Because technology, even in the property sector, continues to go up or continues to improve. The reason why all of those charts are going up is because the dollar is going down. And this can be quantified, and this is that chart over here. So this is USM2, the USA money supply. Again, this is a linear scale. We can also have a look at this on a logarithmic scale. And isn't that fascinating? Isn't it interesting how this almost looks like a straight line? Of course, there are some outliers. For example, here, the COVID stimulus, which now a few years later led to monetary tightening. But overall, this is a relatively constant trend. This line, by the way, goes up by 6 6.8% per annum. So that is really how much the money is devaluing over time. If you are not saving in assets, but you're just saving in plain old cash because you're worried of those 50% drops that happen every now and then, you are losing on your money 6.8% purchasing power per year. Now, most people think it's only around 3% or 4%. That is wrong. The official CPI inflation numbers underrepresent of what actually is going on with the monetary expansion. Because again, here's the thing, there is technological progress. So things get cheaper and cheaper to produce. Producing a loaf of bread today is much easier than say 500 years ago, right? We've got all the machinery that's now doing this. And over time, also the crops might become more efficient, the techniques to plant things and to make things, it's all getting automated, it's all getting cheaper. And because of that, if we had just a constant money supply, prices of everyday goods should actually come down every year because it gets easier and easier to make those goods. Now, in reality, we know that prices are not going down. Prices are going up, but they aren't going up by those 6.8%. They only go up, say, by 2 or 3% because the other 3 percentage points, they are the technological progress. So the technological progress, to a degree, is working against the monetary expansion. But what this also means is that whatever good you want to buy that is limited in supply and that cannot just be produced better and better every year, those kind of goods are going to increase by 6.8% per year. And so really, if you're interested in goods that are rare, if you're interested in things that are not just mass produced, if you want to get an exclusive education for your children, or if you want to buy a house that has a good location where there's some kind of scarcity of land, you will face those 6.8% per annum. So if you don't increase your income or your wealth by that rate year over year over year, you are falling behind and you will be less and less able to buy those kind of things. You will only be able to buy the mass-produced stuff. And now that we've got the monetary supply, we can now adjust the price performances that we've seen in all of those asset classes relative to the monetary supply. Or in other words, we can pretend there is zero printing by the Federal Reserve. We can pretend that there is no monetary expansion. We can live in the perfect world. We can actually now see truly what assets return in real purchasing power if we remove the monetary expansion, if we really look at what's going on. And so here's chart number 1. This was my very first eye-opener. I have never seen anybody else doing this. I just made this chart out of curiosity and it really changed my perspective on investing. This is the S&P 500 divided by the US money supply. And to have this on a somewhat readable scale, we also multiply this by a 1 with a few zeros. But have a look at this. This chart starts in 1959, goes all the way to today. And sometimes the S&P 500 does worse than monetary expansion. Sometimes it does better. It goes up and down and up and down. And the magnitude of those ups and downs is absolutely flabbergasting. Have a look at this. This is a drop of 74%, and this here is a rally of 470%. If you bought into the S&P 500 at the end of the 1950s and you just waited it out to get the same kind of purchasing power, not to get the same US dollar valuation, but the same kind of purchasing power, you had to wait for 36 years. An entire generation, zero additional purchasing power just to get your money back. Now, there are a few adjustments to be made here, right? Because the S&P 500 also pays dividends. But on the other hand, we also have potentially management fees, right? Let's say you have an actively managed fund and potentially you also have to pay taxes. So it depends on how you've set this up, right? If you're completely optimal and you buy something like VOO, so a very low cost index ETF, and you hold this into an account where you don't have to pay taxes, or you hold this in a country where you don't have to pay taxes, then you might be beating the monetary expansion, right? Because that comes on top of this price development. But if your dividends more or less equal the management fees that you have to pay or the taxes that you have to pay, then this is really the performance that you get after the monetary expansion. And it is pretty much non-existent, right? It's from the 1959s to today, the performance of 47%. So that's less than 1% per year. And even that might be a very generous estimate. We might get even less than that, but more on that in a second. Just looking at this chart long term, we can already say that we tend to not be that cheap in stocks. But we're going to look at more convincing charts about stock valuations later on. So this is a chart everybody looks at that makes you convinced to buy into stocks. It's the US dollar valuation of the S&P 500. But once you take away the devaluation of the US dollar, the performance really is pretty much non-existent. You are not buying stocks in order to make money. You're buying stocks in order to escape the money printer to a degree, right? Those 6.8%, that is a tax of monetary dilution every single year. And so this changes the mindset to a degree, right? It tells us the real story. It tells us that still we have to buy stocks. We still have to own assets because of the fiat devaluation, but also gives us a realistic sense that we're not going to become rich just by buying stocks. We are simply just preserving our purchasing power, at least if we just buy and hold, and we don't try to time the market in any manner. If we were to time the market, we should be rather selling our stocks right now. Only at the end of the peak of the dot-com bubble had we been that expensive in stocks historically. But let's continue. Let's have a look at the gold price, right? Because gold, of course, went up as well. And so a lot of people are afraid to buy gold now, right? It's close to its all-time highs. Why should we buy gold? But let's have a look at gold relative to the monetary expansion. Here is that magical chart. Gold keeps pace with monetary expansion. It does not see the 40% outperformance that we've seen with the S&P 500. It simply just went flat, but this can just be short-term fluctuation, right? If we just go up another 20 or 30% in the next week, we might see the same long-term performance of gold as we do see with the S&P 500. Isn't that fascinating? Are we now very cheap or are we very expensive in gold? It's very hard to say, right? But the S&P 500 historically definitely looks higher on the chart compared to where gold is. Gold had a point in history where it was 4 times more expensive compared to today relative to the money supply. We cannot say the same for stocks, right? For stocks, it's only another 14% to the all-time high. But of course, the fair valuation isn't at this point here either. And so this is, I believe, already a very controversial take. If you don't have the perfect setup for stocks, if you just buy an actively managed fund and you sometimes pay taxes on your stock investments, then gold long-term might return just as much as stocks. There is this common narrative that stocks perform way more because it's active capital and you deploy your dollars into companies that work hard to make more returns. Thus, you should be earning more on stocks than on gold. On top of that, we also have more volatility in stocks, as in the prices go up and down much more aggressively than they do for gold, right? Gold is way more stable. Thus, we should be thinking if there's more risk and there's more activity in stocks, that it should outperform monetary expansion better over the long term. But we've just seen this, right? If you don't have just super cheap funds and if you don't have zero tax, then gold performs the same long term relative to stocks. They both just keep pace with monetary expansion. Now, is this true for all stocks? The answer is no. There are some stocks that historically outperformed monetary expansion. And surprise, surprise, those stocks are the growth stocks, right? So the riskier stocks, the technology stocks. Have a look at this. This is the NASDAQ 100 relative to monetary expansion. And since 1985 to today, that outperformed by 1,850%. Now this is a real return. This is an asset class that made you, quote unquote, rich over time. If you bought Microsoft, if you bought Apple, if you bought Amazon or Google or Netflix, if you bought just the NASDAQ 100, right? Not even the best technology stocks, just the top 100, you did do much better than monetary expansion. Now, this does not come without risk. Again, this year is the dot-com bubble burst. So this is where technology stocks underperformed monetary expansion by 86%. And then over here, we've got our second crash. This is the global financial crisis, a move to the downside of 55%. So yes, there is risk in investing. But when we've got a chart like this, right, when we've got a chart that long-term outperforms monetary expansion, it is okay to buy the dips, right? Then it's not that scary to buy whenever things are crashing. You don't have to wait for 30 years to get your purchasing power back. That's also why it makes sense to, for example, buy Bitcoin, right? Bitcoin, of course, can crash even more. It goes down by 70 or even 80% during a bear market, but it does also recover within 1 or 2 years. So if the time horizon is long enough, and I'm not talking about saving for the next generation, I'm just talking about saving for the next 5 to 10 years, then those risky assets actually become less risky because we do make money over time. We do gain purchasing power, and the crashes are an opportunity. And so this is the part of the video where I want to talk about opportunity costs. I want to talk about what asset to buy. We've already established that holding just fiat currency is a bad idea because it devalues by 6.8% per year. But because all asset prices go up over time because of that devaluation, it's very hard to tell what asset is really worth investing in at any particular point in time. And so, of course, we can adjust the performance of an asset by looking at it relative to the money supply, but we can also just look at assets relative to one another. Then we also completely take away the monetary expansion, right? Because the monetary expansion has an impact on both asset classes at the same time, to the same degree. And so have a look at this. This is now the NASDAQ 100 relative to the S&P 500. So this is how do technology stocks perform relative to regular stocks, to all other stocks. And again, we see a nice outperformance since 1985 to today, an appreciation of 400%. But again, we do also have our risk. This was a crash of 70%. So this is not where technology stocks just went down 70%. They went down 70% more than just regular stocks. But let's ignore this dot-com bubble. Let's say this never existed. We'd still see a relatively constant increase over time. So it does make sense to own technology stocks over regular stocks. If we buy stocks at all, it should be technology, in my opinion. It's not worth it to buy just the S&P 500. I think QQQ as an ETF is better than VOO at the right point in time. Is it now the right point in time? Probably not, but more on this in a second. But again, the S&P 500 doesn't beat monetary expansion that much, right? If we want to be risk off, we might as well buy something else. We might as well buy gold, for example. Now, what we see here behind me was another massive eye-opener for me. It's something that you have never seen before, very likely, and it's something that really changes the perspective on investing again. This is the S&P 500 relative to the gold price, very long-term, since 1884. And yes, one might say that the S&P 500 is outperforming gold over the long term, but can we really say that this will continue? Because during all of those years, we also got more and more adoption, right? In the early days, nobody owned stock. Now everybody is owning stock. We also have pretty high valuations in general in stocks right now. So maybe this could even crash back down to where we had been at the end of the 1970s. We just go sideways and we perform exactly the same. But here's actually what's the eye-opener. This crash over here, which was partially fueled by the oil crisis, this was a drop of the S&P 500 relative to gold by 95%. Stocks in the span of 10 years underperformed gold by 95%. Did you ever expect that kind of a shift in capital movements? That much volatility? I did not expect that when plotting this and putting this into the charting program. And the same is true the other way around. When you bought stocks, when everybody was so hyped about gold and you held it for 20 years, you outperformed gold by almost 4,000%, a 40x difference. That's how important it is to ride those kinds of waves and to be on the correct side of history. If you were a pessimist in the 1970s, you made bank. If you were an optimist in the 80s and 90s, you made bank. So So it's very much dependent on where we currently are in the cycle. And even though I try to simply just show objectively the data here, I will also show what I believe is likely going to happen moving forward. We could, in theory, see something similar again to the 1970s. And I will show you why. But let's quickly have one more look at those 1970s. What actually happened here? So we had this massive underperformance of stocks relative to gold, but stocks actually didn't go down that much. They actually went up by 22%. So if you're in delusion land and you look at all of the prices just in US dollars, because that's all you know, and you never really think about monetary expansion, etc., then everything is fine, right? You get the same kind of dollars, even a bit more after those 10 years. But the people that are not delusioned and that bought gold instead during that time, they made more than a 20x. So the stockholders, they got slaughtered. The gold holders, they made all their money. But if you then bought gold and you missed the train, then the next 20 years, you lost it all again. It's all about opportunity costs. Don't think about US dollars. You've got some purchasing power in this capitalistic world, and that purchasing power can buy you a few tickets to use for consumption, right? US dollar bills, or that purchasing power can buy you gold, right? Something to be risk off, or it can buy you a participation of the economy. Don't think about this all in just those tickets that devalue over time. This is the wrong way to think about it. You don't want to shy away from gold just because it's at all-time highs in US dollars. It does not matter. It's not at all-time highs relative to money supply, and it's clearly not at all-time highs relative to stocks. Now, this is stocks relative to gold. We can also look at this just the other way around, gold relative to stocks. It is comparatively cheap. Again, I'm not talking about what's going to happen tomorrow or the day after tomorrow or even next month. I'm talking about the next decade. Imagine everybody suddenly gets spooked out because of the tariffs and because of the deglobalization and because of increasing interest rates coming from the increasing measured inflation rates, right? Because now less gets imported, everything becomes more expensive, the economy tends to contract, layoffs potentially start, who knows? Let's say some kind of black swan event happens, then gold is likely going to do pretty well, despite it already being close to $3,000. But again, the dollars don't matter, right? We don't want to have that money in dollars anyways, because then it's melting away very, very quickly. We want to have the dollars in something that is somewhat rare, or that is somehow producing something that can beat monetary expansion, where we can escape that hidden tax. Now, I talked about this now several times on this video, and I want to now show you why I believe that stocks are very expensive now. This here is a long-term chart of the Wilshire 5000, so this is an even more extensive stock market index compared to the S&P 500 relative to the US GDP, so the gross domestic product, the output of the US economy. How expensive are stocks in aggregate relative to the output of the US economy? Why is this chart so useful? It's useful because, again, it takes away US dollars from the equation, because both the output is measured in US dollars, but also the valuation. And US dollar divided by US dollar is nothing. So we don't have the impact of the US monetary supply expansion here. We can clearly see when stocks are cheap or expensive. And of course, they were pretty expensive at the dot-com bubble. They were also expensive, relatively speaking, to what we then saw with the global financial crisis, right? The property crisis in the US. And now we are at all-time highs. We've never been that expensive in stocks relative to the US economy output. Here's another measure, quite similar. This is the Shiller PE ratio. So this is a 7-year moving average of the price to earnings ratio. When you are buying stocks, you're basically buying the future earnings of a company, right? You try to figure out what will be the earnings in the future, what kind of dividends or cash flows can I expect from that company, and then the price that you're willing to pay, right? That's simply just what's at the market. So you look at the price of stocks relative to the earnings historically over a 7-year average. You do the averaging because earnings do fluctuate quite massively over time. And when we do that exercise, again, we've got the market cap of those stocks in US dollars. We've also got the earnings in US dollars. US dollar divided by US dollar accounts to 1 or nothing. Thus, this fluctuates in a somewhat stable band. Over here was the massive crash in the 1930s. Over here was our deflation in the 70s, right? Where gold outperformed stocks quite a lot. Over here, gold gold also outperformed stocks a lot. And we are back again at 38 PE ratio across the S&P 500. You now pay on average 38 years of income when buying a stock. Rarely have stocks been that expensive. And so this approach can be used for all kinds of things, right? But it's important to get away from US dollar valuations. You don't want to hold the US dollar anyways, besides just regular expenses. For everything that you've got on top, you have to buy something that can beat monetary expansion. This approach is useful for crypto. This approach is useful for property. This approach is useful for stocks and of course also for precious metals. Now there's one more opinion I want to share in this video, and it has to do with what potential hedge we can buy besides just gold. Because if you also believe that stocks are likely not very cheap right now because of the PE ratio and because of the GDP ratio and because of its price relative to the monetary base or relative to stocks, then here's an alternative to gold. This is silver. Silver and gold is highly correlated, so they both go up and down at the same point in time, but there are slight differences, right? It's similar to say Bitcoin and Ethereum, or say Amazon and Google and Microsoft. There is correlation, but one asset might sometimes be better than the other, and this is gold versus silver or silver versus gold. So when this is very high here on this chart, silver is expensive. When this is very low on this chart, gold is expensive. And this chart again is very long term. It starts in 1931, almost 100 years of data, and there historically we are very cheap in silver. So silver is, I believe, also a very good diversifier. Most asset classes that don't have a ton of risk just tend to go with monetary expansion. Property is like this, the overall stock market is like this, gold is like this as well. There are a few asset classes that outperform monetary expansion, tech stocks and Bitcoin of course being among them. But since there's so much volatility in those asset classes, and since they sometimes can drop by 50, 60, 70%, we need to have something to hedge against those drops to potentially buy the crash, right? We don't want to hold cash, because then if you hold all that cash, that melts away in purchasing power, and then we buy the crash with some dollars that aren't worth that much anymore. We still want to hedge ourselves with something that doesn't devalue over time. And I believe the best hedge is gold and silver, and especially silver right now. Silver is extremely depressed. Now, I don't have a crystal ball either. I don't know if gold will go up from here or down from here or spin in circles, to quote something in Wolf of Wall Street. But I try to use the data that's as clean as possible. And if we don't use US dollar charts, we already take away the monetary expansion. And if we then look at relative valuations to one another, I think we get a somewhat clear picture. We don't know what's happening tomorrow. We don't know even what happens in 5 or 10 years. But does it make sense to buy the thing that tends to be rather cheap, historically speaking, if there is no real reason why it should be that cheap? Is there really a reason why gold should now be that cheap? Does everything look super optimistic for the next 20 years? Or are there potentially some risks that could materialize themselves potentially? And then being in gold might be very useful. So I try to be as cool-headed as possible about this. I try to not involve any emotions. I am not a gold buck. I'm not a Bitcoin maximalist, and I don't just save in stock ETFs. I try to buy the thing that makes most sense at the time. If you found this content useful, and if you think that somebody else might be benefiting from this, then feel free to, of course, share this video with that person. It's very much appreciated. Besides that, of course, in case you haven't yet subscribed, there's also that button over there. A like would be very much appreciated as well. See you in the next video, or potentially see you in premium. There's also premium membership that's down below, thebitcoinstrader.com. Cheers.